Yeah, there.
Thank you so much, Michael, and hello and welcome everyone to today's panel. We have a great panel ahead of us. We have a very distinguished panel to talk about what went wrong in the market structure in this past year and maybe how it has impacted the market today and how it has changed it. And we're going to talk about or discuss ways in which maybe we can, how different players can maybe work together to create a better infrastructure for the crypto market. Michael already introduced our distinguished panel, so I'm going to get right into it, and I want to talk to Mike, who's the CEO of BitGo, which is a wallet company and a custodian, and I want to talk a little bit about the case for separation of custody and exchanges. The SEC has proposed that registered investment funds should be required to use an independent custodian, and this is something that the traditional financial world has made an important rule decades ago. And a lot of people in crypto think that this is a very necessary step for this industry as well. So Mike, do you agree with this, or do you see a world in which exchanges could offer both?
Well, great. It's a great debate, great question. First off, we just had this panel that was up here talking about non-custodial and decentralized wallets. And at a retail level, what they're talking about is super important. The great thing about digital assets is we have the ability for everybody to participate, whether you're retail, whether you're professional, whatnot. Now, when it comes to people that are managing other people's money, which is the people that are investment advisors, regulated by the SEC today, we've always held them to a higher bar, higher level of accountability. We need to know that they're not, advising you in one direction while simultaneously taking the opposite direction for their own personal wealth and things like that. And how do you accomplish this? Well, part of it is by really understanding the risks of the different roles that are being taken, and part of it is by creating some separation of duties, some checks and balances between parties, et cetera. So the crypto environment was born without a market structure. There was no market structure that was willing to touch it. And it's evolved today, of course, into this very verticalized pattern where you see a single vendor that is the exchange. They are the buyer's broker, they're the seller's broker at the same time, they're the clearinghouse, they're the custodian, they do everything in between. This has a lot of risk. It can be made to be very efficient, it takes out middlemen, that's a good thing about it, but the bad part about it is that everything goes unchecked. So take a look at FTX, of course. Look, they operated in this same exact pattern. Would splitting them up have prevented FTX? No. First off, it's massive fraud, and there's always possibility of fraud, and there's bad guys out there that will commit fraud, whether it's Bernie Madoff or Sam Bankman-Fried. But could it have detected some of it? Yes. And could we have segregated custody all the way out to retail in a way that could have totally prevented it? Yes, it's another step away. So yeah, we at BitGo, we hit a lot of institutions, pension funds, and the most conservative money is having a difficult time participating in digital assets today because they have to put 100% counterparty risk on this one guy providing the full vertical stack. So in general, support, and then I think the challenge is going to be how do we legislate and regulate our way forward to something that's really workable and good for everybody.
John, you're the president of Cboe Digital, which is a US regulated exchange, and Guy, you're the global managing director for Kraken. What is your argument from the exchanges side? Do you agree with Mike, or is there maybe an argument against it, and maybe exchanges, there could be a world where exchanges could offer custody as well?
Right, so I think we're trying to just make sure that we have an environment in which customers are safe, customers can trust the venues where they either exchange or trade or do the things they want to do. In traditional markets, we've seen that the separation and everything else with regards to clearing brokers, introducing brokers, custody, that didn't prevent market failures. It still happened. It happened in 2008. It happened before that. So I think there's no fail-safe mechanism, even in traditional markets. Crypto markets behave differently, and we have an opportunity to actually do much more for the customers to show that their assets are custodied with the exchange. So Kraken introduced the proof of reserve concept to demonstrate in a way that's far superior, I think, to kind of audits that are happening in TradFi, that the assets are where we say they are, that the wallets are there, that the assets are there, and they can see for themselves that there's, that we have the reserves against the liabilities to our customers. So I think that so as long as we keep segregation of customer assets, so as long as we keep the right safeguards, I think that we can have both under the same house in a way that is safe and responsible.
Yeah, I think, at Cboe Digital, we think about it maybe a little bit differently in the sense that we want to allow our customers to have a choice, right? So if a customer wants to use a specific custodian, right, and they want to trade on our platform, we need to figure out a way to let that happen. But if I think you go back and you look at the start of crypto and an exchange or a platform is, in order to sell a Bitcoin, we had to know that you had it to be able to sell it. So it kind of inherently made us become a custodian in order to do that, because I don't think the technology wasn't maybe there yet. Though we're starting to see custodians offer these solutions to allow customers to trade out of cold storage wallets that they connect or use directly at a custodian on different platforms. And so I think that's a natural evolution of the ecosystem and a natural evolution of customers' demand and choice for that separation. I think we've seen that separation in other asset classes, and so I think naturally we believe we'll start to see more and more of that separation in crypto as it evolves. And from an exchange perspective, we just need to be on the same page and support that in order to provide growth opportunity for our platform.
Right. Chris, you're the trader in this round. You're the head of Cumberland, which is a trading firm within DRW. One of the key changes in the market in this past year was the lending market, which completely turned upside down. We saw big players like Voyager, BlockFi, Celsius go bankrupt. How has that influenced capital formation?
It's a great question. So I don't think people realize historically how thinly capitalized crypto market participants have been. DRW, the parent company of Cumberland, we're rather well capitalized, but we still engage in the lending market. And what we found was that the importance of the lending market for smaller participants were almost a kind of an existential requirement. And as a result of the lending practices that existed about a year and a half ago, you ended up having a lot of participants being over-levered. And as a result, the liquidity profile of the market, I think, on its surface seemed much healthier than it actually was behind the scenes. Because as the leverage gets washed out of the market, you get liquidations, you get larger price spikes. Something interesting has happened since that washout. And what I mean is the lending platforms that are still available have much stricter controls. They have the right best practices in place, right? They're not offering unsecured or under-collateralized lending like they used to. They're not allowing people to have like cyclical lending. They're margin calling people much quicker, and they're just being much more thorough in kind of who they onboard. And as a result, a fascinating thing has emerged. The first is that leverage has dramatically reduced in the market. So that might be because people have better risk practices, but I think it's partially because finding that capital is much more difficult. And I think what the immediate reaction to that would be is that the markets are less liquid and more prone to bouts of volatility and price variance. But that's not what we're seeing. What we're seeing is that while there might be less capital available to the market right now, there's not as much leverage in the system anymore. And as a result of there not being as much leverage, the price dislocations that we saw, say, a year ago, 2 years ago, aren't as significant and aren't as frequent. So while capital formation, I think, has become much more difficult for the more thinly capitalized organizations, the market has actually become more resilient. And as a result, I think organizations like ours and organizations like other larger institutions look at this and say, maybe we can deploy new products because the risk is more manageable, because the risk is much more kind of known. And so despite the fact that the lending market has fundamentally changed over the past year, I think it's changed for the better. And I would be shocked if we don't start to see more traditional organizations step in and start to offer capital and offer leverage, which much tighter controls that will ultimately improve the capital formation side of things.
I do want to talk a little bit about liquidity and the banking crisis. We saw the mistrust in the banking sector a couple weeks ago certainly affect Bitcoin, and it's certainly profited, moving above 30,000 for the first time since, I believe, a year now. But I think a lot of people had hoped for a little more upside. So I was wondering, to what extent has thin liquidity in the Bitcoin market prevented Bitcoin to rise to the occasion, so to say?
Listen, I would argue that Bitcoin did rise to the occasion, right? If you think about one of the kind of core theses of Bitcoin, it's protection from debasement of fiat currencies. And any time a banking crisis emerges, the first question you ask are my dollars safe? And the second question you ask is, are my dollars worth what they used to be? And I think as a result of this situation, despite the fact that there was profound downturn in financial markets over a short period of time and a lot of uncertainty, Bitcoin rose to the occasion in that it offered individuals a way to hedge that risk. Right? So if you think about, well, in a falling prices environment, why can Bitcoin be growing or why can the price be rallying? One of the most obvious answers is people need a safe haven to put their assets. And I think those that aren't kind of crypto native would question this, but if you're worried that your bank isn't going to be there tomorrow, if you don't want to have your assets under custody on a platform, no offense to any platforms here, you don't have many other options other than to rotate it into stablecoins or rotate it into crypto assets. And I think what we saw was a very aggressive rotation out of custodied assets and out of dollars into Bitcoin, which was much more transferable and at the time as liquid as the market needed it to be. Now, what I think is going to be important is on the back end of it, inevitably there will be a kind of a sell-off as a result of the banking or the banking environment improving. But the cat's out of the bag now, right? The idea that bank deposits are risky in a way that people didn't truly recognize and understand, and that there's a viable alternative to those bank deposits is now an appropriate and a kind of an acceptable thesis for people looking for a safer place to put their dollars.
Speaking of keeping your money safe, John, Cboe Digital is a U.S. regulated exchange, probably more so than most exchanges in the ecosystem, and Guy, Kraken, obviously a regulated exchange as well. To what extent is being a regulated exchange a business disadvantage in the Wild West market that we're in?
And I think we have to think about maybe that question over a period of years. So if we spin back to when we started Cboe Digital in 2018, and to start, we've been fairly conservative in the products that we offer our customers. We list 4 tokens plus a stablecoin today. Those 4 have been prudently selected based on our belief that they're not securities, and we did that intentionally in that standpoint, and we haven't expanded kind of given the current regulatory climate we're at. And so if we look back at 2018, that you probably could argue was a little bit of a disadvantage in terms of our ability to grow maybe as rapidly as some of the other platforms that offered more, right? If you think about you want to get exposure into crypto and you want something other than Bitcoin or Ether, maybe you want Solana or you want Filecoin or you want something else, you can't get it on Cboe Digital. So why have 2 accounts, one for BTC and one for something else? You're going to go to the place that offers you everything, right, or as much as you can. And so I think that maybe was a disadvantage for us. If we fast forward to kind of where we're at today, I think the mindset has shifted, where we're starting to see participants seek out venues that are not vertically integrated, as we talked about, where there's clear separation of duties. We operate just an exchange and clearinghouse, and that's it. And I think that message is starting to gain some traction. And I think safe havens or flight to safety outside of just holding it in Bitcoin, folks are looking at their counterparty risk and saying, where do I want to operate on, and in which case, how do I want to do it? And I think it's actually starting to become a strength for Cboe Digital. So I think it's actually flipped on its head over the last, call it 6 or 12 months as we've seen what's happened in the industry.
Yeah, and I think we all want to see the crypto industry kind of grow. And while we at Kraken feel that there's a great importance to DEXs and decentralized or decentralization in general, there's still a very important role that centralized exchanges play, and that is if you want to see more institutions allocate to crypto, they would probably do that with centralized exchanges. They would want the the security and the assurances and all the checks that their control functions need to do in order to allow the business to allocate to crypto, that can only happen for the most part with centralized exchanges that can provide all these things. Not to mention elements like customer service, things of that nature, where centralized exchanges is probably better in offering that. So I think there's a kind of a critical role for centralized exchanges while allowing for DEXs to grow and kind of experiment and do their thing. And we're going to see a lot of investors interact with these protocols, and we should definitely continue to support this innovation. But if we want to see the institutional part kind of growing and the adoption growing in registered investment advisors, right? That's a big opportunity for the industry. They would only interface with a centralized exchange that can provide them with all the necessary checks and balances that they need in order to onboard to crypto and allocate to crypto.
There is a whole another panel on derivatives, but John, I wanted to ask you about Cboe's physically delivered futures, and where do you see potential for that? I know you guys haven't launched yet. Maybe you can give us an update on that. And maybe how does demand compare to that of cash-settled futures? Do institutions want to handle real Bitcoin?
Yeah, and I think the use case is very specific, and I think it goes back to the concept of choice. And I think just a step back, we're working through launching what we refer to as margin treatment in a fully regulated clearinghouse under the CFTC, and so hopefully be able to bring that to the market sometime this year. And when we do that, we'll offer both a financially settled or cash settled futures product and a physically settled futures product. And I think it depends on the type of business you're in. Obviously, there's a use case for cash settlement in the sense of maybe you don't want to actually hold the coin, or maybe you can't hold the coin. And I think given the current regulatory environment, there's a lot of institutions, a lot of participants that want to gain exposure to derivatives. It provides leverage, it provides different use cases that may be holding the spot, and maybe they can't hold the spot. So the only way they can gain access to price in Bitcoin is via futures contract. Versus you may have participants that are active in the spot market, and they may want to trade basis, and they may want to generate a yield on their crypto holdings. And so an avenue for them to do that, either of the two, is through derivatives. And a physically settled derivative offers them a little bit of a different vehicle to do that. So we see demand growing, especially in the US, for both. But there is clearly a market mostly for cash settled derivatives today. And we believe there's strong enough demand to bring a market for physically delivered as well.
Chris, you want to follow up on that?
I agree with that. We're very pro physically settled futures if you design them right. And I think that gets to the broader point of the debate about product market fit in the crypto industry. We've seen many iterations of many potential solutions that think that they have the solution to the problem without actually understanding the underlying problem that the users have. And I kind of have a unique perspective here as a customer as opposed to a service provider. But one great example is the futures. Bakkt a while ago launched a physically settled future. And on its surface, it seems very relevant, and it seems kind of exactly what you would want out of a physically settled asset. But the problem was there was an SLA for the delivery of the physical asset post-expiration. And that SLA was not immediate. It was over the course of hours or potentially a day plus. And if you think about a user of these products, one of the reasons why you're going to want that future is to trade the basis. In one case, you'll be long future, short spot, or vice versa. The other way that you trade the future is maybe you're a speculator, right? But most speculators typically don't take the asset into expiration, they just roll it. So really the problem you're trying to solve is physically settled expiration for big basis trades. Now, if I'm short a bunch of spot against the future and the future expires, but it takes me 2 days to get delivery on the spot assets, I now have 2 days worth of, you could call it duration risk, you could call it market risk, whatever you want. But there's no way a large organization is going to carry a $100 million basis position into expiration when they need to wait 2 days to get delivery on the physical asset. So you kind of need to solve a problem that's not obvious on its surface in order to actually get the right product for the market.
Right.
And we see this in a few other places. I speak to this group because I think this is a relevant problem for them, but the idea of on-chain settlement and the debate of disintermediating the risk associated with bilateral settlement it's a good problem to solve. But you can't just presume that if you put the settlement into a smart contract or a centralized kind of escrow agent, you actually solve the problem. You really actually need to solve the DVP problem, which is, how do you make sure that the information associated with the delivery of the asset is kept separate from the delivery of the financial aspect of it, yet they only happen in an atomic all or none sort of way. Like these idiosyncratic requirements that traditional institutions have, I think are starting to permeate the crypto industry's infrastructure, and we're seeing people actually thinking about them intelligently. So, as they talk about the products that they're launching, I think they're more in tune with what the actual use cases need to be as opposed to a conceptual, what if we just built this approach. So I think it's positive to see.
I'm curious, how much wash trading still goes on at exchanges? And how many trades are bot executed? And maybe you can talk a little bit about, is that a welcome phenomenon, or is that?
I mean, I'll start in the sense that I'll say, at least at Cboe Digital, it's zero. One of the things that we do specifically in Spot is we've written a rule book that we bring in from the CFTC's kind of futures perspective, and we have a regulatory department that oversees and makes sure that our participants are abiding by those rules as they operate on the platform, and it's very traditional finance-esque. And one of the things you can't do is wash trades. That doesn't mean that it doesn't happen. And I think it's a pro for the industry to move that way. Obviously, I think it'll lower tradable volume. And I think, how the global crypto environment wants to solve that problem, obviously, is via regulation. But specifically in the U.S., as we see the crypto ecosystem evolve, wash trading is inherently a no-no, I would say, from a regulatory perspective in the U.S. And so, I would encourage everyone to think about it from that perspective.
Yeah, and on Kraken, wash trading is prohibited. We have tools and capabilities and procedures to make sure this is not happening on the exchange. But as I said before, the wash trading exists in traditional markets as well, and I think in crypto there's an opportunity to make it maybe even a bit more robust to make sure it doesn't happen on exchanges. In terms of bot trading, it is permitted on Kraken. You can definitely develop all sorts of kind of algorithmic trading capabilities and integrate to the exchange. I would say the two kind of most exciting maybe things that are currently happening in the world is AI and crypto in a way, at least to my liking. So I do feel it's kind of a welcomed phenomena. We can see all sorts of interesting use cases and interesting capabilities being developed with AI and an intersection of AI and crypto. However, we still need to make sure that everything's fair and everything's transparent and everything's done in a kind of in a way that is compliant. But yeah, we welcome that, and we want to see how AI kind of continues to maybe contribute to the development of crypto.
Mm-hmm. There have been a few statistics showing that there's a slight shift from centralized exchanges to decentralized exchanges. First of all, are you seeing that as well? And then I guess second of all, why would I, as a trader, put my money in a centralized exchange as opposed to a decentralized exchange or a cold wallet?
And I think I can start, and then Chris, if you want to jump in, or anyone. I think from a centralized perspective, I mean, the models between a DEX and a centralized exchange are completely different. In the sense of a DEX, you have this concept of automated market making. There's some price that's based on supply and demand. It's not necessarily a group of firms representing price. And so there's a number of maybe things that I think are challenging surrounding the results of that type of trading, especially as it grows. And also the concept of who's going to set the price on that exchange. So it's almost like a DEX needs a centralized exchange in order to know where the price exists. So I think the two can't, or at least one can't exist without the other. But on a centralized exchange, we're running a central limit order book, which is a grouping of many, N to infinity type of participants representing their price, right? And that's the price to buy and sell, right? It's adds significant amount of liquidity, and I think it provides a tremendous amount of stability in a marketplace when there's volatility. Think about an example of a runaway kind of algo, which we've heard, numerous times throughout history. It'd be interesting to see what would happen on a DEX if you had a runaway algo continue just to buy up the entire price versus on a traditionally focused exchange, you have circuit breakers, you have market makers that are representing risks that are going to update as they see information and trades happen. And so you're going to get a better reflection, I think, of what the market is and likely a more stable market than maybe something that's based on, just a pure formula.
Anyone want to follow up?
Well, I'll add a little bit more. The decentralized exchanges, they're definitely promising for the future, but they're not ready today. You try to trade on it, the usability, of course, is weak. But moreover, we're still figuring out the kinks. We've had a number of various pools exchanged, smart contracts hacked in all kinds of different ways. Who the other participants is not yet fully figured out. If you're a regulated institutional firm, it's difficult to participate today, but everybody wants to. So we're going to get there, but it's 4 or 5 years behind the centralized crypto spot markets. So of course, there's just more work to be done.
Yeah, and I think Mike is right here. There's a place for both, and every participant's going to have different requirements. If there are a requirement to have AML and KYC procedures in place in whatever platform you trade on, then you are unlikely to dive into DeFi too aggressively right now. Your pool of where you can go is pretty limited. But it's really difficult to ignore the power of the primitives of some of these DeFi platforms. Remember, I got into a conversation about the lending market post Celsius and BlockFi and Voyager. And when that was all happening, our risk department came and asked us, what our perspective was on things. And I said, well, listen, I could only speculate as to the health of all the centralized lenders right now. We don't have full transparency. We have a general sense of what they might be at risk of. So we need to act accordingly with imperfect information. And this was kind of the watershed moment for me because I'm talking to our risk department, which is a TradFi risk department. And I said, I could tell you with absolute certainty, putting aside smart contract hack risk, I could tell you with absolute certainty where the risk in the lending market is in the DeFi side, because I could tell you by looking at these protocols, what the liquidation price is for all the ETH-backed loans. I could tell you whether or not the upstream wallets to those loans have the collateral to post if they need to. I could tell you if they're active in the past hour. I could tell you if the feeding wallets above them have been active in the past hour. And I could tell you in real time how those liquidation prices are changing. I said, you need to understand the power of this information. Imagine if you had that during 2020 or the banking crisis in 2008. You wouldn't have to question whether or not Fannie or Freddie were potentially in trouble. You would know. And so I think there's the one approach, which is can an institution trade in DeFi or act in DeFi? And that has its own questions. But the other question is, which of those primitives are the institutions just going to adopt, right? The beauty of DeFi and blockchain technology is a lot of it's open source. So I think the potential for a TradFi institution to adopt some of those DeFi on-chain primitives, but wrap it in their institutional offering is very high. And I would say, if you're going to see mass adoption in that direction, it's probably going to be because of one of those types of solutions as opposed to a DeFi native solution.
Maybe to finish up as the last question very quickly, how do we restore trust with regulators and banks, and how much of a priority is that for all of you right now, given that it seems like everybody is already moving away from the US? Whoever wants to go.
Well, so, okay. Anytime I get asked a question like this, my answer is there's no reason why innovation and regulation need to be mutually exclusive. It's just it's this construct that the industry has created that I think is totally unfounded. Yeah, it's true that there's some energetic debates in the United States, but you also need to look at the progress that's being made, and kind of frame your thinking around the fact that traditional markets and commodities markets in general in the United States have been around since the 1850s. There's been a long time, a lot of time put into thinking about how to regulate these markets. So, what are the positive signals that we're seeing? Well, the House Financial Services Committee put out a stablecoin draft, or stablecoin bill draft recently. It's directionally good. Whether or not it gets through the House and then Senate and the President's desk, who knows? But it's a good show that they're thinking about it and doing so intelligently. The CFTC has a number of different working groups. I'm on one of them. It's called the Global Markets Advisory Committee, and crypto is a topic there, and they're engaging with the industry to understand what they should be doing. And then you kind of overlay that with what you're seeing out of like Europe and MiCA, and Singapore and MAS and their Payment Services Act. So there is progress being made if you know where to look for it and where to engage on it. So I think it's important that we focus on those positives and continue to move the conversation forward.
Yeah, I'll echo what Chris said. I'll add that I think as participants, we need to be willing to educate and engage with all our regulators in a way to move it forward. So, I think everybody's just as frustrated as everyone else in the sense of like, we want to see some clarity. We want to be able to rapidly expand our businesses. But I think to your point, technology sometimes moves faster than laws or rules are made. And so I think at the end of the day, we just have to understand that. But if we don't help educate our regulators and their staff on the innovation and what we're trying to do and show them that we can do it in a way that they've watched other institutions do it for hundreds of years, then I think we're going to continue to see kind of the two ends of the spectrum that we see today. So just that continued engagement I think is really important. The other, I want to swing back to the DeFi comment. The one thing that I think we miss in DeFi is it's not all one size fits all, right? So it's not everything needs to be in DeFi, everything needs to be in CeFi. I think there are fantastic use cases, to your point, in where DeFi can go, and there's fantastic use point for CeFi, and they need to coexist, but we shouldn't always just say, is it CeFi or DeFi, and should trading be on CeFi? Maybe borrow and lending, fantastic for DeFi, but maybe a central limit order book obviously is a hard concept to cover there.
Yeah, so we at Kraken, we're definitely looking forward to continue to partner with regulators worldwide to make sure that the rules of the road are clear and we can play by the rules, and we have successes in Canada recently where the regulator with the OSC kind of putting us on a path to be regulated in Canada. We had successes in Ireland, and we look forward to continue that on a global scale, either under MiCA or under kind of regimes kind of worldwide. And in the US specifically, we feel that crypto is a bipartisan issue. We feel that it should be embraced by kind of both parties. Definitely looking forward to the House kind of Financial Services Committee to partner with the House Agriculture Committee and come up with some sort of a way to provide better clarity for the industry, which would allow the US to maintain its dominance in the financial markets, because crypto is the future. It's inevitable, so we're definitely looking forward to that.
Awesome. Well, I think we've run out of time, but thank you so much for experts to give us your opinion, and thank you everyone for joining.
Thank you.
Okay, thank you everybody. Thanks so much. Okay, so